around the world. This is FXPassion, broadcasting you live on YouTube. Happy Friday. Hello Aquos, happy Brexit to you. Hello Annie, how are you? Everybody, this is Forex Trading Course 101. And remember the three pillars, right? The strategy and or the system, the risk management, which we are going to talk about today, and the psychology part, everybody. If this is your first time, please go back to the Ducascopy YouTube webinar page and start to watch Forex Trading Course 101. Why is that? Because we are in the last module, the professional one, and we are talking about hedging and the trading business. Okay, also remember that 90% of traders lose money in the Forex market worldwide, and the webinars are not for trading or investment advice. The webinars are for educational purposes only. Hello Miguel. Miguel, did you receive my email? I answered to you about the Fibonacci's this morning. And for homeworks and or questions, everybody, you have my Gmail contact, my Skype contact, and my LinkedIn contact. That being said, today the title is Hedging Part 2. So we are going to move on with education, and let's review what we have learned so far. So number one, a hedge is for protection and not for profit. Number two, hedging is not suitable for all traders. And why is that? Because hedging is considered and classified as a high risk strategy. Thank you, Miguel, no problem. In reality, hedging is very safe but also very misunderstood. Number three, a hedge is a trade. A hedge is a trade. Number four, if not done properly, is going to blow your account. Mine also. And number five, a hedge is going to increase your risk. We're going to talk about the risk today. Okay, so 1, 2, 3, 4, 5. Those are the rules and the risk acknowledgements. Time to shine. Hello, boss. And we opened, right? We talked about, we shorted the Euro JPY and we hedged with the stop loss. Buy, hedge, stop loss with 0.5%. And the rules. Rule number one, you cannot put a hedge everywhere and anywhere, everybody. You need to have a technical reason that can explain the hedge. Why is that? Because a hedge is a trade. And another rule, when you are wrong with the original trade or with the hedge, you must close the trade with the loss. Okay? And 4 stars, you don't want the hedge to be triggered. Hedge is for protection and not profit. And lastly, right, we talked about what traders do, right? Not just beginners, but also professional traders, how they are going to lose the account, or at least how they are going to experience a big drawdown with hedging. Right? How can you burn or destroy your account with hedging? So you are just closing the hedge trade with profit, and you are leaving your original trade opened, right? And again, one of the most important concepts to be aware, or you can make it as a rule, you don't want your hedge to be triggered. Okay, that being said, let's check Euro JPY. So we put a hedge right up in here, and we were not lucky for the market to reverse. So we are still waiting, right? We are still waiting for the market to hit our hedge. Now today, what I want to talk about is how the hedge is going to increase the risk. How the hedge is going to increase the risk. So let us find a spot, maybe here. Okay, great, there you have. So we have an up Fibonacci, everybody, on the, it's just an example. We have an up Fibonacci on the daily chart. and the market is retracing, right? The market is retracing and is doing this, and finally, right, finally the market crowned. Okay, so, but this is the daily chart. We're going to write this down. This is the daily chart, right? Now we are going to enter the trade in here. This is going to be our entry. Let's color code this in green and edit label, entry. This is going to be our entry, and our hedge is going to be down here. This is going to be our hedge. Remember, you don't want the hedge, okay? The hedge must be in some technical place. You cannot put a hedge everywhere and anywhere, okay? And of course, our original trade is going also to have a stop loss. So this is going to be the stop loss area. Let's make it in red, like this. Edit label. This is going to be our stop loss. Okay. Okay, let's write it down. Stop loss. Okay. Stop loss down here, and the pink one is going to be our hedge, right? So it's going to be a sell stop order. There you go. Okay, 1 2 3 4. Now let's talk about the hedge is going to increase the risk. Why is that? Well, let's say that we're going to risk per trade is going to be 1%. Okay, now risk of the hedge, let's say that is going to be 0.5%, right? Okay, 0.5%. Okay, so if we just take the original trade, so edit label risk per trade, we're talking about the original trade, and we said, well, if the market is going to go down from our entry for any reason and stop us out, right, then we are going to lose 1%. Okay, now our hedge, instead of the stop loss, we are going to have a hedge. Our stop loss of the hedge is going to be up in here, right? Why is that? Because the stop loss of the hedge also must be, so this is going to be like this. Okay, so our hedge must have also this stop loss, right? Stop loss of the hedge. So the red one is the stop loss of the hedge. Why is that? Because as we said, a hedge is a trade, everybody. Okay, a hedge is a trade. Now let's talk about the different market behaviors that can happen. So market behavior number one, right? Risk per trade, we're talking about the original one, is 1%, and the risk of the hedge is 0.5%. Now, just graphically, is if this is the risk of the hedge, and let's color code this in red, and we're going to clone this just graphically, right? So if we are going to take a profit, right, if the market goes down, and passion is not clear, I have a comment on the other streaming platform, everybody. Okay, yes, just give me a second. Just give me a second, we're going to explain everything. Okay, so step by step, our original trade is based, step number one, okay? Our original trade is based on this crown. Okay, our original trade is based on this yellow crown, and our original trade is based on the Fibonacci on the daily chart. So we have the A, we have the B up in here, we have, or maybe sometimes we are not going to have it, we have the C. Okay, if it's confirmed or not is not relevant right now. And we have the D, right? Green goes to green, so our target is the D. Okay, nothing special, nothing, right? Nothing confusing. So this is the original trade. We entered because all of the stuff that we learned already, right? Because of the counter trend line break and bullish candlestick formation near some level of past support, right? Counter trend line break, all of this stuff, right? And we can choose or put a stop loss 10 pips below the C, right? But now we are learning how to hedge. And Fibon crown, yes, you can do it also. Okay, Fibon crown, right? So this is our entry. Okay, and we put a hedge, a sell stop order now without the hedge. So number one is the entry. Okay, we learned about entries, we have all the reasons to enter, right? We have also the indicators, the MACD, maybe the stochastic, whatever. So we entered into a trade without the hedge, and if the market went against us without the hedge, we would be stopped out. This is number two, right? But instead of the stop loss below the C, we optioned to put a hedge, right? Now what is a hedge? A hedge is an order. A hedging is an order in the opposite direction of our original order. So in plain English, we want to make money with our buy, right? So we want the market to go up. Now with the hedge, we are going to earn a portion, and we are going to lose in the same time. But with the hedge, we are going to earn a portion when the market, and if the market, of course, is going to go against us. Why is that? Because we want to make money with the buy, right? And if the market goes down and trigger our sell stop, is going to become a real sell order. So we are going to earn money with our sell order. And as we talked last week, in the same time as we are earning money with the hedge, we are also losing money with the buy, right? So this is going to be our loser is in the red. This is our, so let's put some text. So buy order losing, right? So this is our red, buy order is losing, but our hedge, right, which is a sell order making money, right? So the sell order is making money, the buy order is losing money. Okay, so this is where we say a portion of the hedge, is going to, if the market is going to, we are going to enter here, and if the market is going to go down, right, and we have our take profit in front of the A, right, because we need to have a metric, a logical metric, a technical metric. It could be also, you can work with hedges. Instead of the Fibonacci, you can use structure, you can use big levels of support and resistance, pivot points from the monthly and the weekly, doesn't matter. But for the educational purposes, we're using Fibonacci. Okay, so if the market goes down, trigger our hedge right, and hit. Let's use the hedge as a pink, with a pink color, and hit our take profit, right? Our original trade is in red because we are losing, buy order is losing, but the sell order is making money, right? But because look just graphically, if we are risking 0.5%, and this is the graphic illustration now, right? And remember, the hedge is not for making money, it's just a protection. Now we are going to make more or less half of this, right? So hedge profit is going to be 0.25%. Why is that? Because just graphically, the green quadrant is half the red quadrant. Okay. Now this is our plan. We would like to close the hedge, right, and do what? Wait for the market to reverse, right? So what happens if the market is not going to reverse? If the market is not going to reverse, and if the market continues to push down and hit our sell stop loss, how much did we lose, everybody? In this scenario, we entered with every reason to enter, but the market pushed down, right? Hit our hedge order. We had a profit with 0.25%, but the market continued and stopped us out on our original trade. How much did we lose? 0.75, correct? Yes, sir. Okay, this is one scenario. Okay, now I'm going to delete most of the things. Delete. Okay. Now, why the hedge is going to increase the risk is, statistically speaking, everybody, most of the time, what does the market do? The market is going to go up, is going to go down, is going to hit our hedge, and then is going to reverse and stop the hedge out. How much did we lose in this scenario? How much did we lose in this scenario, everybody? If the market goes down, hit our hedge, which is going to be a sell order, and stop the hedge out, how much did we lose? 0.5%, correct. So, and when we talk about risk reward, everybody, now here is where the hedge strategy becomes risky if you don't understand. Okay, now let's play with numbers. So we risk 1%, okay, and our profit target is 2%, right? Why is that? Because risk reward is 1/2. Now if we are, let's say, lucky and the market hits the D, how much did we earn in this scenario? We risked 1%. We, instead of being stopped out, we put a hedge with 0.5% risk. Our risk reward is not the best, but most likely is going to happen. It's 1/2. And finally the market hits our target. How much did we win? Time to shine, 1.5, correct. Now this is where you should get worried, everybody. Okay, now passion, but we won. Yes, we won, but remember all the previous lessons, everybody. The trading game, for the lack of a better word, it's a probability game, and it's intrinsically connected to the risk-reward strategy and the risk-reward ratio, right? So if we won 1.5%, was our risk-reward 1 per 2? Yay, we won, right? We should be happy. Now this is, everybody, this is where the hedge becomes dangerous. Danger. Okay? Why is that? Because we didn't work, we didn't earn. No sir, correct. We didn't earn 2%, right? So meaning, if you have an edge, if you have a strategy that is profitable, if you mismanage your strategy with the hedge, you aren't going anywhere, everybody. Not just you, me also. Right? So this is where we are telling you, and this is the easy stuff, that we are going to show you another, a little bit more difficult example. It also happens time to time, right? This is where we are telling you the hedge is going to increase your risk, because maybe in the end you are going to hit your profit, but because the market also hit your hedge, you didn't make 2%, but you made 1.5%. So your risk reward was not improving, but because of the hedge, your risk reward downgraded because of the hedge. And I have a question, not on YouTube but on the other platform. Passion, so isn't the stop loss better? Well, there is no right. I don't have an answer for you, everybody. You know, like FXPassion, I'm using hedges. I also use a sell stop. I also use a plain stop. If I analyze a chart and I don't see any reasons to hedge, then I am going to use a plain stop loss. But if you say, oh, isn't the stop loss better, right, or isn't hedging better, well, I'm going to tell you my experience. I am making more money with the hedge. Okay? What does this mean? This could mean that I'm not the best trader, you know. Maybe I'm not skilled enough to use the stop loss. But what works for me, everybody, maybe is not going to work for you. Anyway, we are here about the education, right? We are going to tell you, and as we always say, you can accept this, you can learn, you can also reject. Everybody, no problem. Time to Shine is asking, so in this case, to place a hedge, we need to find an original trade of 2.5 to 1. There is no formula. Time to Shine. So in theory, yes. In theory, yes. Okay. In theory, yes, but this is just an example. The market is always waving, and many times it's not going to position itself like this. Okay. In theory, yes. Now this is going to be, this was the easy, right, the easy scenario. Now the third one. What happens, everybody, if the market, you entered the market, you put a hedge order, the market hits your hedge order, stops you out, and then reverses and stops you out with your original trade? How much did we lose on this one? How much did we lose on this one? Miguel is saying one thing should be clear: the hedge is a protection for a portion of your original trade, not to entire one. Yes, sir. Exactly. Exactly. Correct. Time to shine. So if this happens, everybody, if this happens, right, we are not going to lose 1%, we are going to lose 1.5%. Right? And you do this 5 times, everybody, and you are going to experience a significant drawdown, right? You are going to, so now for the student who posted the question, why, well, it's not true, the stop loss the best option. Well, I don't know, you know, because if this happens, of course, it's going to increase your risk. Why is that? Because a hedge is a trade. A hedge is going to have a take profit level, and a hedge is going to have a stop loss level, right? And if this happens, you are not going to lose 1%, you are going to lose 1.5%, right? And if it happens the previous, right, let me see if I cannot go back. If it happens the previous example, when the market hit your stop loss of the hedge and shoot to your take profit, right, you didn't earn 1%, I mean you didn't earn 2%, you earned 1.5%. So the hedge, everybody, is mixing with the risk reward, okay, and it's increasing, everybody, it's increasing your general overall risk. Okay, so what is the solution to that? The solution to that is, and this is a rule, everybody, okay, rule, okay, rule. The solution to that, everybody, is if operating with the hedge, okay, we are going to talk about a business operation. Okay, this is just vocabulary, don't worry. But we are not going to use the words risk per trade anymore. Okay, so we are going to use risk per operation, and this risk per operation is going to include our original trade, and this risk for operation is going to include also our hedge. Okay, so this is in the beginning. This is what beginner traders do, professional traders losing money, you know. Now, what is the solution? The solution is going to be in here. So this is the solution. Okay, so we are going to determine risk per business operation. Okay, you can also have a vocabulary like XYZ, doesn't matter. So risk per operation, business operation. Okay, so how much is the risk per operation in this example, everybody? If you understand what I'm talking about, you should be able to put the risk per operation in here. How much is the risk per operation, everybody? And remember, I have a 20 seconds delay on the chat. So I'm going to use my original trade and I'm going to use the hedge. If everything goes bust, how much I'm going to lose? Time to shine, 1.5, yes sir. Can you please explain to the other students how did you come to this number? But you're correct. So the risk for this business operation, everybody, is going to be 1.5%. Right? This is the risk for operation. So if everything goes bust, we are going to lose 1.5. Passion, can I have a lower risk? Yes, it's a choice, everybody. It's a choice, but this 1.5 is based on this. So this was the problem in the beginning, where the hedge is going to increase our risk, right? Every time the hedge is stopped out, we are going to have a lower profit, right? Or if it's going to stop us out and with the original trade we are going to have increased risk. So So the solution is we are going to bring together the risk per trade and the risk of the hedge. Thank you, time to shine. Yes sir, everybody. So how to come there? So you just put the risk of the original trade plus the risk of hedge. Okay, so risk reward could be the same, no problem. Risk reward could be the same, right? So what is our profit target? So if we have a risk per operation 1.5%, what is our profit target, everybody? How much? With the risk reward 1 per 2. This is an easy one, everybody. This is an easy one. Correct, yes sir, 3%. 3% is the profit target. Okay? Now, until here, everybody, until here it's easy. Should be 3, yes sir, yes sir. Okay? So, this is the business operation. Okay? Now, what is difficult to understanding here is this is a business operation. This is not the buy trade and this is not the sell trade, but this is all together. Okay? This is the risk of this operation. If everything goes busts, I'm going to lose 1.5%, and if everything goes okay, then I'm going to make 3%. Right? Okay. Now I'm going to delete here and delete here and delete. Okay. Now this is the risk per operation. So now question for you, let's think together. I want you to think, everybody, how much is going to be risk per trade, and I'm talking about the buy. What do you think? I'm going to, so my risk per operation, I'm talking about the business, right? Talking about the strategy. If everything goes busts, you know, it's like a real business, you know. I'm opening a pizzeria and I hired 2 pizzaiolos, 5 waiters, I rented the place, I put my marketing on social media, and I'm expecting customers. So, and if everything goes bust, I'm going to lose 1.5%, meaning I need to fire the pizzaiolos, I need to fire the waiters, I still need to pay the rent, you know. So if the business go busts, I'm going to lose 1.5%. But risk per operation is not the same the risk per trade, everybody. So what is the risk per trade? Remember, the risk reward is 1 per 2. What do you think? And don't worry, everybody, there is no right or wrong. We are here to learn. Okay? Somebody says risk per trade is how much? 1%, 1.5%. What is it? Risk per trade. Well, if everything goes alright, everybody, we should earn 3%, right? With this business operation. So if I'm risking 1 per 2, what is the risk? If I want to have 3%, what is the risk per trade? The risk per trade is 1.5, right? So risk per trade is 1.5. 1.5, everybody. 1.5. 1.5. Risk per trade for the buy. Okay, now everybody, Miguel says 1%, Ako says 1.5%, 1 divided 3 times chances 0.75. Everybody, if the market, if let's say that you entered the trade and the market went to your take profit, right? So what you want, everybody, is to earn 3% with this operation. Now if you are risking 1%, Miguel, you are not going to earn 3, you are going to earn 2. If you are risking 0.75% time to shine, okay, because of the risk reward is 1 per 2, you are not going to earn 3%, right? You are going to earn 1.5. So risk per trade for the buy is 1.5. If I'm risking 1.5 until my stop loss, everybody, and it's 1 per 2, then I'm going to earn, and I'm talking about this business operation, I'm going to earn 3%, right? Passion, this is difficult to understand. I know, don't worry, we are going to spend a month or 2 with hedging, okay? But the profit is based on the risk reward ratio. So example number 1, we entered into a trade, the trade went to our D, so we went earning 3%, right? Okay, now, whoops, let me see. Okay, now, do we agree, everybody? Do we agree until here? It's a tricky question, I know. Do we agree that the risk per trade must be 1.5? What do you think? Do we agree, everybody? I know it's a tricky question, you know. So, solution, we are talking about the business operation, right? We want to risk 1.5. Okay. Now, of course, we have a question, Passion, but if you risk 1.5% on your buy, you don't have any more space to risk the hedge, right? So how can I have a hedge here if I'm risking the whole risk of the operation is in my buy order? Isn't something wrong, everybody, in here? Something's wrong, right? Right? Okay, so what we are going to do, everybody, we are going to save the same parameter, clone, whoops, not this one. Okay, let's write this down. So because of the risk of the hedge, okay, I'm still going to use the 0.5%. It's a choice, okay. I'm still going to use my risk of the hedge of 0.5%. Okay, now I'm already, everybody, I'm already exceeding my risk per operation, right? So what is the solution? What is the solution in here? As you can see, the hedge is going to increase your risk in any way. Alright, so what is the solution? Akko says the 3% is not compatible with Fibonacci target. Akkos, we are not talking about graphically, okay? We are talking about numbers. Okay, everybody please focus on numbers. Akos is saying, well, but if this is your graphically, if this is your risk, then 1 and 2. Akos, I think I was thinking that I understood your comment, but I don't understand you. What's the problem with 3%? Akos, if you would be so kind and explain what do you think. I thought that was the risk reward, but risk reward also graphically is okay. What's the problem with the 3%, Akos? Would you be so kind and explain further so I can help you? So, what is the solution, everybody? Well, the solution is this, and here is where, as we said, here is where hedging is not suitable for all traders and it's classified as a high risk strategy, and if not done properly is going to blow your account, everybody. Okay, what is the solution? Well, if this happens, okay, so if happens that the market is going to hit the D, risk per trade buy is 1%, and if we are going to leave it like this, our risk hedge is 0.5%. What is the solution? Well, and this is where we have an increased risk. In order to achieve our business goal, we need to add positions. Okay, in order to achieve our business goal, and this is a business operation, we need to add positions. So let's make it easy, or at least we're going to try and make it easy. If I'm going to enter my buy order with 1.5 and the market goes up, I'm okay. Now, if the market goes down, hit my hedge, right, and reverses, and I'm not able to close the hedge, everybody, and we're going to talk about next week the different strategies. But let's say that I put into the trading platform the parameters and I went to bed, right? So the market hit the stop loss of the hedge. Whoops. The market hit the stop loss of the hedge. Then, and the market is here, right? It's making higher highs, higher lows. In order to achieve our business goal, I need to add a new position, everybody. Why is that? Because I lost 0.5%. I lost 0.5%, and I need to make this loss back. If I'm not going to make it back, then I am ruining my account, everybody. Okay? If you want to learn something today, you need to add a position, because if you don't add a position, if you don't earn back what you have lost with the hedge, you are ruining your risk reward and you are ruining your account. Akko says, because the original D trade was planned with 1 per 2, but you need 1 per 3 because of the hedge. Not true, Akos, not true. I'm going to have exactly the same problems if I change my risk reward 1 per 3. I'm going to have exactly the same problems. Okay? Everybody, let's explain to Akos first. Okay? So we are here, Akos, okay? We are here. Solution. So our risk reward is going to be 1 per 3. We're going to change risk reward 1 per 3. Okay, so if my risk for operation is 1.5, so 1 per 3 is going to be what? Profit target is going to be 4.5, right? 4.5. Everybody, this is why hedging is tricky, okay? Akos thinks, and it's okay, thank you Akos for your comment. Akos thinks that if I change the risk reward, then I'm going to be safe or have an easier way. Okay, so my risk per operation is 1.5. risk reward is 1 per 3 and my profit target is 4.5. How much should be my risk per trade, Akos? I'm talking about the original trade, the buy. How much is going to be, how much should be my risk per trade? What do you think? If I'm going after 4.5, if I'm going after 4.5 and I have a risk reward ratio, Akos, 1 per 3, how much should be my risk per trade of the buy? What do you think? Passion, I don't like hedging. No problem, everybody. This is an advanced, you know, this is the professional module. Okay? And remember, hedging is not for profit, it's a protection. You don't want your hedge to be triggered. Not suitable for most traders, everybody. Time to shine 2.25. No? Akos 1.5, yes sir. It's the same, right? 1.5, 1.5. Okay? So, how much must be the risk of the hedge, Akos? 1.5, okay. 1 per 3 risk reward. What about the hedge? What about the hedge? 0.5%, the same. Should be the risk of the hedge should be 1% or 0.25. What do you think? Time to shine 2.25 times 3 is 6 something, almost 7, so it's too much. In the meantime, Akos is thinking, everybody, this is the solution. In order to achieve our business goal, we need to add positions. 0.75, okay, so we are going to increase the risk of the hedge. 0.75, right? Okay, now let's delete this one, and let's play around, everybody. So we have a risk reward 1 per 3. I enter the trade, the market hit my hedge and finally reversed, stopped me out with my hedge and hit my take profit. Akos, how much did we earn? How much did we earn in this scenario? How much did we earn? The market went down, hit my hedge order, and then stopped out my hedge order, so we have a loss. And then finally, right, went back up and hit our take profit level. How much did we earn? Time to shine says 2.25. No. No time to shine, not true. How much did we earn, everybody? We earned 4.5%, which was the original target. We earned 4.5 minus the stop loss of the hedge. So 4.5% minus 0.75 is how much? 3.75. So, okay, this is 1. Yes, correct, 3. So this is 1. Now, what happens, everybody, if the market hit our hedge, goes up, stops out our hedge, and goes further down and stops our original order? How much did we lose in this situation? How much did we lose in this situation? We are almost out of time, everybody. So if the market goes down, activates our hedge, goes back up, stops our hedge out, and then goes down and stops out our original trade. Time to shine, 225, yes sir. So in conclusion, everybody, and especially you, Akos, does the risk reward change anything when hedging, everybody? If you change the risk reward, is this going to help you? You know, we tried with 1.2, didn't help, 1.3. So if we change our risk reward, you can find a trade with 125 risk reward. Is this going to help you when you are hedging, everybody? What do you think? It's not, right? Because look at the numbers. When the market went to our take profit level, we didn't earn 4.5, we earned 3.75. And when the business operation went bust, meaning we have 2 stop loss orders triggered, we didn't lose just 1.5, we lost 225. So either way, everybody, either way, the hedge increased our risk. Or we lost more than we planned, or we didn't earn all what we planned. No, great. So what's the solution? As I said, the solution, we must add positions, meaning we must make back what we have lost with the hedge. Okay, this is the solution. Now again, one student on the other platform, not on YouTube but on the other platform, said, isn't just the stop loss, isn't the stop loss better? I don't know. I mean, okay, let's talk in plain English. If the market goes down, hit your take profit of the hedge and goes back up, then stop loss is not better. It's not better. Or if the market just goes down and stop you out, the stop loss is not better. The hedge is going to minimize your loss. But on the other way, if the market has a lot of noise and it's playing around, and we know that sometimes it's going to enter in a period of consolidation, then the answer is yes, the stop loss is better, right? Why is that? Because when we work with the hedge, we need to work 2 times harder, everybody, if this happens. Okay, so there is no simple answer, or is it best to work just with the stop loss? Well, it's easier, okay, but easy doesn't necessarily mean better. Because if we are going to use the hedge strategy, we must add position, we must make back what we have lost with the hedge. Okay, so the problem is in here. Okay, we are almost out of time, everybody. Next week I'm going to show you how to play with these numbers and how to add positions, and we have rules. Okay, Passion, can you lose with the hedge? Yes, you can. Yes, you can, absolutely. Yes, you can. If you don't understand, and we have rules in hedging, everybody. Okay? We have rules. So, what is the rule? The rule is this one. And this is the title for next week. So rule. You can, we can hedge maximum one time per currency pair. Okay, this is a rule. I'm going to explain it next week. We can hedge maximum one time per currency pair. What does this mean? This means that if the market went down and I was sleeping, I didn't close the hedge soon enough, and the market stopped me out. I mean, the market stopped out the hedge. I must re-enter in here. Okay, but as soon as I'm going to enter another trade, I'm going to increase the risk again. Why is that? Because the market can fall back down again, right? So if this happens, then in the second chance I must not, it's a must. And again, there are different hedge styles, different hedge metrics, different hedge strategies, but as a rule, as a trader in a hedge fund, as a rule, you can hedge maximum one time. In the Forex market especially, 24 hours a day, right? So I'm going to enter again, put my stop loss down here, and if the market goes down, that's it. This is the business operation. Okay, what does the beginner trader do? The beginner trader is going to open another trade and is going to put another hedge in here. And this is a sure way, everybody, to ruin your account, to lose all of your money, to lose everything you have, because you are going to increase the risk 2 times, 3 times, 4 times faster with hedging. Okay, and again, what is the problem with the hedging? The problem is hedging is purely psychological, everybody, because we all do love making money and we all hate losing money, as we talked about last week. Okay, everybody, our time is up. I hope you learned something today. Please watch this webinar over and over and over again and try to understand the challenges with hedging when the market moves in different ways. Okay? Happy weekend, happy Friday. See you back on next Friday. Okay, everybody, let's relax and see you back next week. This is FXPassion signing off.